There is some debate about how early and how aggressive the central bank is going to potentially cut rates in 2024. Following Tuesday's inflation report, traders trimmed their rate cut expectations after the latest inflation data showed that the Fed is still a far ways away from getting to its 2% target. Fed swaps now pricing in the first rate cut likely in May. For more on this, we want to bring in Jack Manley. He's JPMorgan Asset Management Global Market Strategist. Jack, it's great to see you in person.
Yeah.
Once again, let's talk about what we will likely not so much hear from the Fed and hear from Jay Powell this afternoon, but really looking ahead to 2024, because there's so much expectation, so much optimism around the fact that the market seems confident the Fed is going to cut in the first half of next year. Do you agree with that sentiment?
I don't necessarily agree with that sentiment, and I think that the Fed is pretty keen on this, embracing this narrative of higher for longer. You know, we've seen ample evidence, including yesterday's CPI print, that inflation is well on the way to achieving that target of 2-ish%. But there is still more room to go. And what I think is important to remember here is that moving from 9% last year to 3% this year, that was the easy part, right? That was supply chain issues getting resolved. Now moving from 3% down to 2%, that's going to take a lot more work. And the concern I have is that there's too much excitement about the timing of the first rate cut, that they're going to be that the market is anticipating too many rate cuts next year, and I think there is a little bit of room for disappointment in that, frankly.
Okay, so with regard to that, I mean, we're already looking at some of the earliest calls for a rate cut coming as early as perhaps the first quarter in 2024, taking that off the table and kind of getting more into the frame of mind that you have. If we were to see rate cuts next year, when do you think they would begin?
Yeah, if we see rate cuts in the first half of next year, it is because something bad has happened, is my view on this, right? It is an indication that the economy has deteriorated in a certain way. Unemployment has spiked. GDP has meaningfully decelerated. That has forced the Fed to move more aggressively than initially anticipated. And that's bad news. We don't want to root for early rate cuts. We don't want to root for more rate cuts next year. We want the Fed to be able to take its time, because if it's taking its time, it means that nothing is broken yet. In that vein, Brad, I'm thinking back half of next year is when we start to see interest rate cuts. I'm looking for roughly 25 basis points of cuts per meeting, which adds up to maybe 3 or 4 cuts in the back half of next year. So
consecutively?
I would say probably consecutively. Call it 75 to 100 basis points, but sort of backloaded into the second half of 24.
So then, Jack, what does that mean then for the equity markets, at least in the first half of the year? If the market's a little bit too optimistic in terms of maybe the fact that they do think the Fed will likely cut rates, does that mean that we should expect more volatility in the first couple of months?
Volatility is the name of the game. You know, if you think about what has been happening to markets so far this year, it has been driven overwhelmingly by a very small handful of names, right? We spent a lot of time talking about the Magnificent Seven. And a lot of that, of course, has to do with what's going on with AI, a lot of it having to do with these sort of somewhat miraculous seeming weight loss drugs, these GLPs, right? But a lot of it also has to do with this assumption that the Fed's going to start cutting, it's going to start cutting soon, and it's going to start cutting aggressively. And so I think there is room for some of that outperformance recently to unwind. But the story that we have been sort of pounding the table on over the last several months has been opening up the opportunity set a little bit and remembering that there are another 490 plus names in the S&P 500 that haven't done a whole lot of anything. So it's volatility certainly in 2024, but I think a really ripe environment for good active management across style boxes, across sectors, finding those names that are reasonably valued, that are punching above their weight class from an earnings contribution perspective.
And so I think that's what our viewers are wondering too, right? At the end of the day, how can they still make sure that they're seeing a return on investment positively, even in volatility? What is the top strategy that you would be employing next year?
Well, I can't believe I'm saying this honestly, Brad, but like my number one conviction in 2024 is high quality, intermediate duration fixed income, right? Call it 3, 5, 7 years, kind of the belly of the curve. It's just enough duration where if you get the call right, you make a boatload of money. If you get the call wrong, you're still kind of getting paid to wait because of the coupon cushion. We haven't seen a fixed income environment like this in a very, very long time, and so why not embrace it? I think there is also a sense of urgency associated with fixed income investing right now, because we have to remember that when the Fed starts cutting rates, and it will start cutting rates, it's going to continue to cut rates through 25, through 26, And in 2025, in 2026, the fixed income market is not going to be attractive like it is right now. So it very much is kind of a strike while the iron's hot type investment strategy.
What about though when you take a look at equities? You mentioned there going back to the fact that you expect at least or hope to see more participation from the other remaining companies outside of the 7 that have really dominated the market action this year. Within some of those sectors, who do you think, if you're taking maybe a more defensive approach to that, who is the best positioned in your view?
You know, I think that the large cap banks are in a very good position. That hasn't really played out in performance necessarily, but I always like to lean back on what's going on with net interest margins. And even as the Fed starts to cut interest rates, you are still looking at a very, very healthy spread there, because none of those rate hikes were passed through onto your checking account. None of them were passed through onto your savings account. And with a lot of the regional banking turmoil that we saw earlier this year, the big banks have been that much more capable of defending those ultra low yields that they are paying to their depositors. So a ton of money to be made in this environment, even when rates are moving lower from Fed policy. So that, I think, could be an interesting sector to play.
What do you believe the Fed says today? What's the tenor that they have to strike in order not to spook the markets overly?
They're going to have to toe a line here, and it's going to be very, very difficult to make sure that markets don't get spooked. But you know what? We forget this. But the Fed's job is not to manage the market. That's not what the Fed is here for. Right. And it shouldn't think that way. The Fed has an economic mandate, maximum employment, price stability. That's what it answers to Congress with. And so I don't think the Fed should be paying too much attention to what the market does. Reality says that they will, right? So my guess is that you do see Powell acknowledge that a lot of progress has been made on the inflation front, that you have seen some cooling in the labor market, but that it is still quite a strong economy, right? Because they want to set the stage for this soft landing. And I think we need to gradually push out that first rate cut, to make sure that everybody kind of slowly gets acclimated to this idea that we're not seeing aggressive cuts in the first quarter of next year.
Jack Manley, JPMorgan Asset Management Global Market Strategist, joining us here in studio. Thanks so much, Jack.
Thanks
Great
a lot.
to see you.